Can a 100% base covered call ETF strategy beat the market? We are talking indexes like the S&P 500, the NASDAQ 100, the TSX 60, the Dow Jones Industrial, and the Russell 2000. Well, in this video, we are going to build a couple of covered call ETF portfolios using the covered call ETF AllStar tracker to look at performance of an overall portfolio, see what gets close to beating the market, see if anything can actually beat the market. And as a bonus, stick around because I wanted to address a couple of things that were brought up in my last video regarding taxation of a $150,000 covered call ETF based portfolio. So with that in mind, let's go. All right, everybody, what you are looking at here is the covered call ETF AllStar tracker. This is a spreadsheet I developed to track the health and the history of the covered call ETF industry, spanning across Canada, the US, with a bunch of other great features like tracking yield and tracking AUM over time, average volume. I have even distributions in there as well. Anyway, that's a lot of info to look at, but we're not here to tour the tracker. We're looking at doing something very specific, which is build ourselves a portfolio and compare them against 5 indexes, which you can see right here. This is actually something new to the tracker that I added in October. I put out a new one monthly right at the start of every month. So adding in indexes are going to be a great way to just gauge where a potential portfolio might be at, or maybe you just want to play around with combinations and see what's actually possible. And I wanted to show everybody that, especially with the indexes that are now included inside of the tracker. So for starters, if you are to build a portfolio, what we really want to do is kind of get rid of just a whole heap of funds here. So I'll give you basically 2 examples of what it looks like to actually build it, not just click on a tab and it's already built. So if we're gonna actually build a portfolio, what we wanna do is just clear out everything. So we click on clear. The things that we'll add back are all the indexes, which are all asterisked, so that they just always appear at the top. Whether it's under fund manager or under ticker, they're always going to be at the top no matter how you filter any of this. So let's just say, for example, you are maybe curious about, what if I invest in in a portfolio that is all-in-one base, meaning ETFs that invest in other ETFs. Okay, so that would be HYLD, HDIF, HDIV, we can do BMAX, we can also do EQCL, and then we'll see what that gets us. Okay, so this is a pretty common all-in-one based strategy. I invest in all of these funds as my strategy is very much, I want to get the best of both a capital appreciation and yield at the same time. And what is basically the highest that we can get that is basically a nice equilibrium is really what I'm trying to say with that. So let's just scroll across here and just go to price performance. Now we can see the price performance for all of these indexes that are right here. Obviously, when someone talks about beating the market, typically they're talking about the S&P 500, the 500 biggest companies in the States. So if we highlight over performance, which you can, on your side of things, which is a view only format, all you really need to do, it'll most likely be, it might be a little hard to see. I think this portion might be cut off a bit, so I apologize for that. I don't think I can bring it over, but if you can't see it, what you're going to see is something that'll say the sum of the percentage. So we want to change that to average. And again, if you can't see it, it just says 10.15%. That's a performance that is just equal weight across those 5 covered call ETFs. So that's just price performance alone, which actually is like phenomenal considering if you've heard many things about covered call ETFs, they're gonna like NAV erosion and capital depreciation into oblivion, then maybe that might surprise you. But let's add in the dividends for total return. So that's capital appreciation and dividends included, and we get 19.85%, which certainly gets us well above the Dow Jones Industrial. That gets us well above the Russell 2000. That gets us just a hair above the TSX 60, but we still are behind the S&P 500 at 21.64% and the NASDAQ 100 at 21.32%. So maybe what we could do is just add in just basically a price appreciation booster. So for this example, let's add in HTAE. A little biased to that since I also own HTAE. And anyway, let's highlight what we get as price performance. So that certainly has helped us out. Year to date, total return, that's 21.05%, but it still lags behind the other indexes. Now, I think it's also important to mention that if you are investing for income, I think it is natural that we want to compare ourselves to the index, maybe to prove a point to a friend. And I'm guilty as charged of this as well. I very much still like comparing myself to the S&P 500, albeit it's changed over time. I don't take it as seriously as I once did. And it's still also just fun to do. But if you're investing in covered call ETFs and you're trying to do it to beat the market, this is certainly, I would suspect, the wrong place for you to be in, right? Investing for income is about quality of life, supplementing costs, and maybe it's for being able to maybe retire early. In my case, that's going to offset a house rental that I'll be getting into next year. So tangible use cases in the now. Okay, so we have a portfolio here of all-in-ones. We have a slight a price appreciation booster in HTAE, which is a pure tech fund. If you were to cobble together a portfolio of just pure tech covered call ETFs, on a total return basis, you probably would beat the NASDAQ 100 most certainly, I would think. So maybe like an HTAE, maybe a QMAX, a QQCL, maybe a QQY, at least the Canadian version of QQY. There's a Defiance ticker Defiance ETFs, they have a ticker QQQY, but I'm talking about the Evolve ETFs one. Okay, so we can't quite beat the market with this portfolio. It's still an impressive portfolio, by golly it is. But again, we're trying to see, is there a combination that can actually beat the portfolio that is diversified, it's well mixed, and not just a sector play of something that is hot right now, like for instance, maybe gold, you could say, maybe certain real estate funds, maybe certain bond funds. I think you could certainly do that. But we want something that's diversified. We still get fund manager diversification. So again, let's try for that. So in this next scenario, I'll just clear it out, everything again. We'll add everything back. It just makes things a little bit easier just to do it that way. Let's add in, not all-in-ones this time. We're going to stay away from that. Let's add in pure index-based covered call ETFs. So in this case, I'm talking about ESPX. I'm talking about ETSX. Let's add in USCL. Oh, we could add in QQCL. Let's add in QMAX. Let's do SMAX, and I'll explain kind of a little bit about these funds just once I'm done filtering through this, but I'm kind of just doing this off of memory at this point in time. We can at least start with that and see where we get. Okay, so these are actually, you know what? Maybe what we'll do, we'll add in QQQY as well. Let's do that. Yeah, we'll add in QQQY into the mix. Is there anything kind of more? Is there anything more S&P 500 style? I would say HYLD, but no, I think we got a decent mix. ESPX, SMAX, and USCL will represent the S&P 500, QQQY, QQCL, QMAX. Those will represent obviously the NASDAQ 100, and then we got the ETSX in here to represent a small portion of the Canadian market in the TSX 60. So on our price performance level, let's see what we get here. Again, if you can't see it, it's 12.05%, equal weight across all of these funds. Again, impressive, but it still doesn't get close to the NASDAQ 100 or the S&P 500. As a matter of fact, pretty much everything beats it out except for the Russell 2000s. But once we add in dividends, what do we get? We get 22.37%, which would crown this portfolio actually king over all of those indexes. So again, that's price performance and total return together. So everybody, if you're interested in this spreadsheet, you can head over to my Patreon, pick it up for yourself. $13 just to try it out for 1 month, and that's reoccurring every month. And you can also get news over there. We also do small group Zoom calls and exclusive videos over there. Anyway, but that's where you can also interact with me. You ask a question, I respond. That's where I prioritize my attention as far as questions are concerned, or that, and obviously the comment section for YouTube videos. But hopefully that will give you, maybe stoke some curiosity of maybe building a portfolio, experimenting with certain things. And I hopefully this was a good way of just showing you all exactly what a combination of funds together might actually look like. And actually before this video, I actually hadn't put together a pure index-based style. So at least this way, it's a little bit more concentrated. The reason it probably can beat out the indexes, you might be scratching your head as like, why is that? Now, some of these funds don't invest in all 500 companies. So SMAX, it tries to copy the sector mix, but you get some of the bigger names. So you get, say, upwards of 20, 25 funds, I believe. QMAX, 20, 25 funds, somewhere in that ballpark. USCL, I think you do get the 500 companies. ESPX, you get basically the 500 companies, I want to say. QQY, I want to say it's like 41. QQCL, the 100. So anyway, some of these are a little bit more concentrated, which does help elevate the performance to it. But it also works in the opposite direction as well. Okay, so with that being said, let's now talk about my last video I put out. What is the Canadian tax cost on a $150,000 CoveredCall ETF portfolio? You guys clearly like that video. It was something I had been meaning to do for a while, but man, you guys responded in droves to that email. A lot of good stuff said about it, but there was also some stuff said in there that I wanted to address because one, either I forgot to mention, or two, just something with the filters didn't look quite right. So some of you had pointed out a couple of things, nothing crazy, but I wanted to address that. So we'll head over to the example that I brought up last week in regards to how much, using a tax calculator by Wealthsimple, how much would a portfolio that looked like this actually cost? Now, I use tickers. You might be asking, why are certain more popular, newer funds aren't in here? I wanted funds that had been around since basically 2022, that had a full tax year in 2023. So these are the funds that I came up with. So I put a little bit more in the all-in-ones, and then we finished out the investments with a few sector funds. So this isn't a portfolio I would necessarily invest in. It was just meant to be an example of taxation costs, not performance, not based on this is the best portfolio for me or for you. It's just I wanted an example of a bunch of different funds that would give us a bunch of different examples for taxation costs. Okay, so the very first thing that was pointed out that I did not mention, that I usually mention in all my tax videos, is regarding ROC. I said that, and thank you, Barb, for pointing this out, if you end up watching this, is that I said that ROC is not taxed, which is true. Return of capital, this section here, is not taxed. However, what I forgot to mention is that, let's just say the value of each of these funds stays neutral and nothing really happens with it. You hold on to the funds, maybe you live off of them, but you never reinvest. And the value of the portfolio stays the same. There is a scenario in which it's a taxation calculation and it does not factor into the actual worth of your investments. Something called your ACB, your adjusted cost base. And so that is calculated by your brokerage, but you can certainly calculate it for yourself. And I do have videos in it, so check out my taxation playlist for it. But you can basically, for the more return of capital that is paid out every single year, your ACB will lower. And if it lowers to zero, then at that point, the next taxation year, then your ROC transitions into capital gains at that point. Okay. So anyway, that part was missed. The only other thing that was also mentioned, also by a regular contributor, Marcel, thank you for pointing it out. Some of the numbers were like, well, in this case, Marcel, you had pointed out HYLD, the numbers didn't quite line up because you looked on the Hamilton website, it didn't match up. Well, it was a silly mistake. It was just, for whatever reason, it didn't filter properly. So this section here, so anyway, everything has now been corrected. So like if you go to the last video and you compare like what tickers were in what order, it looked different. So now I didn't fix anything in here. It was just simply the wrong tickers were in the wrong space. So anyway, that is fixed. That mistake does not affect the overall the totals that we used in our examples. But yeah, it is just something that just needed to be brought up. So I wanted to bring up an example of what it looks like. What do I mean by your ROC will transition into capital gains? Well, in the tax tab in the CoveredCall ETF AllStar tracker, I do have a section right at the end here called ROC to capital gains timeline. And basically, this is just an easy way of figuring out roughly, although it is not an exact science because ROC and basically the ETF tax breakdown changes every year. But it gives you a rough idea how long it would take that if your portfolio or certain funds that you're focused on, if the value was to roughly stay the same and you never reinvested anything, you just lived off the distribution, how long would that take for your each of these funds to transition to capital gains? So this is how long it would take for this portfolio on an individual level to turn into capital gains. Now, if we average it out, and again, if you can't see it, if you make a portfolio based on taxation and you highlight the whole thing, you can get the average down on the sidebar here. Sorry, again, I can't say it enough, but if you can't see it, it's 16.26 years is what that is going to be for the overall portfolio of ROC to turn into capital gains. Okay, so let's move into the actual cost of taxation. So with the same examples from that last video, if we just plug in all the numbers, okay, so once again, what we're going to do is take these totals. We'll take things like other income and total foreign income. We will smush those two together into other income because those will get taxed at your marginal tax rate. Nothing else, everything else stays the same. What is your tax hit if you were to just live off of that investment? Well, the taxation is 0. Okay, and I know there's no section for ROC. That's because we're not inputting that. We just don't calculate ROC at all. Okay, so for the next example, if you have an income of $100,000 $100,000 and only $100,000 with no investments whatsoever, this is going to be your total tax cost, $24,759. But if you have a total income of $100,000 with that $150,000 investment income or investment that produces a $16,000 a year payout, well, that will cost you $26,050. So if we compare the two, what are we looking at? We're looking at, like, call it $1,300, just for easy math's sake, between the two. So your investment income, your $150,000 portfolio in a taxable account will cost you $1,300 if you have $100,000 income. But there's a fourth example I'm going to use that I didn't use in my last video. And so for this next example, this is if you took the rock income, and let's just say that 16 years did pass, and this amount turns into capital gains. How much in total, with everything else, how much are you going to pay in taxes with a $100,000 income? So here we go, $27,731 compared to just making $100,000 with no investment income whatsoever. You're looking at roughly, what is that, $3,000, which I believe the effective tax rate on your investments is something, I want to say it's something like 17% if you had a $100,000 income. So anyway, that's pretty well it for this example. Hopefully you all appreciated what it looks like to build a portfolio and just looking at overall performance, and also the addition of some of these taxation cost examples as well. Hopefully that all makes sense, but as always, reach out in the comments and be sure to hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.